So looking ahead to the week starting February 3rd, Chinese markets reopen for the first time since the Lunar New Year, and of course they are potentially in for a bit of a battering like other markets globally and particularly in Asia due to the outbreak of the coronavirus. We also have the Reserve Bank of Australia setting interest rates, and of course, because it's the first week of the month, we have non-farm payrolls on Friday. Now, in terms of a general backdrop for markets leading up into this week, it has obviously been fairly tumultuous on stock markets. We pulled well off those record highs in the US. European indices have been hit pretty hard. The biggest hit has been to Asia, which again is the epicenter of this virus outbreak. Now, some of these regional markets had to take the hit on behalf of China because the Shanghai Composite and other indices in China were not open because of the Lunar New Year, and that closure was actually extended a few days, and so they are scheduled to reopen on Monday. It's probably going to be a bit of a catch-up to the downside, but I will talk about that shortly again in a minute. Elsewhere in the currency markets, the dollar was generally pretty well bid as a haven. The Japanese yen, despite being in Asia, was generally sought after as a haven. The Australian dollar was absolutely hammered. That was one of the worst performing currencies on the week. The Chinese yuan fell below the key 7 level against the dollar in a sign of weakness of other Asian currencies. And in commodity markets, understandably, given all the uncertainty about how quickly and how badly this virus might spread, gold did well on the week, and oil prices came under a lot of pressure, particularly as some of those airlines started closing out flights to and from China. Obviously reduces the demand for fuel amid all sorts of other demand and supply issues that have been affecting oil of late. So before I get onto those specific 3 issues that I was going to talk about, I'm going to run over the economic calendar. So PMIs across China, UK and Europe, as well as the US, are all the best forward-looking indicators, and they'll be worth watching. Also in terms of the Kiwi, if you're a Kiwi trader, New Zealand unemployment should be quite interesting. And then we have ISM non-manufacturing I'd specifically reference in terms of those PMIs for the US, because that's looking at holding up around 55 with a small increase expected, generally symbolizing the fact that the US has been immune to the slowdown seen more broadly, and that services are making up for a bit of a manufacturing slowdown in the US, and all that should keep the Fed on hold and keep a bit of a floor under the dollar in theory. And of course on Friday it's non-farm payrolls, and I'll talk about that in just a minute. So back to the issue, the Chinese market's open. The big major benchmark index there is the China Composite, but we have some other Chinese indices in the LCG platform that you can trade as well. By the time they open, most of the losses will be in place, but I suspect the weakness might continue depending on how this coronavirus outbreak continues. On Friday last week, the World Health Organization dubbed it an emergency, a health emergency of international concern. And so that further weakened currencies like the Aussie and hit those Asian stock markets particularly. Oil got a bit of a brief lift, although it was still under pressure, as did Wall Street, from the fact that the WHO stepped back from suggesting that travel restrictions were necessary. Actually, it came out in favor of trying to maintain travel and trade where possible. Nonetheless, obviously, nations around the world acting pretty cautiously around this, trying to do the best thing by citizens, and that naturally does mean curtailing some of the trade and overall activity that would have been taking place. And so that's the big fear from a markets perspective, from a cold-hearted markets perspective, that this is going to hit economic growth in China just at a time when they've already got high tariffs from the US. Their economy was slowing anyway, and China's, at the moment, the world's best hope and biggest momentum driver in terms of economic growth. So all that could eventually play out in stock markets, although actually the reaction, we're down less than 5% from the record highs. So it's certainly a decline, but it hasn't gone nearly as far as it could have. Just as a point of reference, during the SARS outbreak, European stocks were down in the region of 20%. We're seeing nothing like that this time around. So it seems like, probably with the help of a lot of liquidity from central banks, markets generally thinking that this thing can be overcome. But of course, we don't know, and that uncertainty remains. Quickly wanted to reference the RBA. So just in terms of recent economic data from Australia, actually the jobs number that we saw most recently from Australia was quite impressive. They added a lot more jobs than we were expected, particularly given the start of the bushfires when those jobs numbers came out, for which those job numbers came out. And then we also had some inflation stats from Australia. So inflation, employment, obviously two main gauges that a central bank will look at. They both looked pretty good and enough, we think, probably for the RBA to keep rates on hold. What I would suspect, though, is that they probably talk down the future prospects of the Australian economy, given the obvious headwinds that it's facing, the bushfires, the slowdown in China more broadly, and now, in fact, and of course, the general trade tensions, and now the potential risk from this corona outbreak, where we've already had a few cases in Australia of people getting the disease, but it's more about the trade that Australia does from China. China is the #1 consumer of Australia's raw materials. So all that to expect from the RBA. Maybe it will be some cause for the Australia to lift off recent lows, because we've hit the highest level in pound Aussie since Brexit, so 3.5-year lows for the Aussie against the pound, but also multi-month lows for the Aussie against the yen and the dollar. So maybe the RBA could be some sort of opportunity to get back into the Aussie after these prolonged declines. Maybe it just extends the momentum to the downside. Let's see. So last but not least, we've got non-farm payrolls. So just so you know, the figures, the expectations are for 156,000 jobs created in the US in January. That's up from 145,000 in December. The 145,000 was a little bit of a disappointment. And so hopefully we get a bit of an uptick from there. Not huge expectations going into this, but we did just have the Fed last week saying that it still expects interest rates to remain on hold for the time being. Although a slight dovish tilt, talking about some of the risks out there, but the labour market was cited as one of the reasons of strength and one of the reasons it can in fact stay on hold. Inflation probably more the figure to watch from the time being. And that notably did come in a little bit softer than forecasts on Friday last week. Right, that's it for this week. As a by the by, if you're interested in some other topics that I'm talking, other than what I'm talking about, then please let me know. What are you interested in? Drop some comments and I'm happy to tackle those specifically on the video. But either way, please, if you do enjoy these videos, make sure to follow myself and LCG on YouTube and social media.